Howdy, it's Mike again. This should be a fun one. We're going to do a combo of two things. We're going to do Google's initial move from its IPO base up until about '07 when it had its first real top before the '07-'09 major bear market. And then I'm also going to walk you through the IPO base, which really came out of trading Google during that time. And I'm going to walk you through how to think outside the box. So, not just the IPO base, but how to really develop something yourself. And I'll walk you through how I develop things and using the IPO base as an example. And hopefully that helps you when you need to invent something, because you know what? Inventing shit is fun, frankly is. I've been doing it for a long time, and it's the only way I know how to do things. So let's start off with looking at, I'm going to share this screen here. Where the heck did that go? There it is. One of these days I'll get good at this. All right, so this is Google on a monthly chart. This is the entire move, since it went public here. Let me just move this over here to make it easier for me. Let's see. All right, so this is the move that we're going to study. And what you can do with monthly charts is really notice the character of the stock. So it had one character during that phase. It went down with everything else during that bear market. Then it changed. When it had another move, you can just see by the slope of this line that it was quite different. And that was really from 2012 to 2018. And what you can see there is that with this RS line, it really wasn't a leading stock. It's just gotten bigger and bigger and bigger, and everyone thinks of it as this true leading stock, but it wasn't really it hasn't really led the market in any big way for quite some time. And it was the way I notice that is the distance from your RS line versus its moving averages, because that's telling you it's leading. So from this point to this point, it was clearly leading, but that was a relatively small phase. But for some reason, we all, myself included, still think of Google as this powerhouse that has these huge moves. But really, the market's had a lot of big move, and it's kind of just kept pace with it. You can see here, that move there, was good from 2020 to 2021, probably its best one since the one that we're going to study over during this time frame. And let's just change the date to we'll go to '09, just to kind of see the RS line a little bit better on there, how much it was outperforming the averages during this time. Now obviously this is a longer term moving average on those relative strengths. And you know what? I know not everyone has watched my prior videos. I would suggest that you certainly watch it before this one. I would actually watch the Apple one. I think that was number 7. This should be number 8. But you don't have to. Hey, you're here. Stay with us. Stay with us. So what you want to do is go to your relative strength lines. This is one of my inventions. And this just simply smooths out the RS line. And again, the RS line is my favorite indicator. It's very, very simple. And it's just a ratio of how the stock is doing versus its bogey. And in this case, we're picking the S&P 500. We could have picked the NASDAQ. We could have picked the NYSE. In fact, you could even put in a different symbol. Like if we wanted to put in a comparison versus Apple, we could do that. But for today, we'll say that for another show. But for today, most of the time we have it versus the S&P 500. And so on a daily chart, we're going to use a 21-day average, weekly an 8, and a monthly a 10-month for our default, or I call it the RS1. And for the RS2, we're going to, for a daily, a 50, weekly 21, and for the monthly 24 months. So two years there. And all these are simple, not exponential at this point. These are all subject to change as I continue on with my research. But we're going to study this phase here. Oops. And then, of course, that major bear market, I mean, that was really, let me just go out another month because it bottomed there. I mean, really, we should do an episode on bear markets and include that one because, that was really bad there. That's your NASDAQ. Now, this one, that was your March of 2000 to October of '02. And oh, we have to do a video on that too, because that, oh man, there's so much to learn. Okay, let's get going or we'll never get to those other ones. Don't let me ramble on like that. So there it is on a monthly, but now we're going to study how you could have traded it. So let's go to, was that '04? All right, so here it is when it starts trading. So the first thing well, I'm getting ahead of myself. Well, that'll be for the IPO base. Let's just get into kind of the fun part of actually trading it. And then we'll circle back to the IPO base. So here it is when it breaks out of what we now know is an IPO base on September 15th of 2004, or at least it traded above its pivot. And you can see this is your pivot there. And if you're using pattern rec, which is another thing that I invented for market surge, it took me a decade for that one. I'll definitely do a video on that one, maybe next week or next few to kind of walk through that. But you can see that it's in stage one, obviously, because it's just starting out. The pivot is 113.48 and the length is 15 days and the depth is 13%. All this is very helpful to have at your fingertips rather than doing it the old school way that I used to do before pattern rec, of calculating all those things by hand and actually counting bars. Like I would spend countless times just counting bars, and it got really old. And it was one of the many reasons why I created the pattern rec and the bells and whistles, just to save you time. So let's go out to the end of the month just to see what ends up happening. This is monster move, right? But we're going to pretend that we don't know that this has happened. And you got to stick with me on this. This is I'm going to stop sharing because this is so important. If you do these exercises either with me on these videos or by yourself, if you can't completely be intellectually honest with yourself and pretend like the information that you know in the future that you didn't have that, don't do these because it'll and I'm not joking, because if you can't get there being intellectually honest, you're going to build up a false sense of reality. And then when you're in the true battlefield and bullets are flying at you, you're not going to know how to react because you're going to be like, oh, well, I don't know how this ended up going, because you don't know. Like, I don't know what's going to happen on Monday. I have a thought of what I think is going to happen on Monday, but I could be wrong. And then you just have to deal with it as it comes. So as you go through these, and so many people do it the other way, even Bill, I'm sorry, it is what it is. Like I would give him a chart of something, to analyze when we were doing some base stuff, and I would call them mystery bases. And he would say, well, what happened afterwards? I'm like, the point is, you're not supposed to know what happened afterwards. You're just supposed to analyze it yourself. That didn't go over well. So that was a short-lived part of the project. But I would do the mystery stocks that way. I would have some people create some charts for me and then go through not knowing what happened. But yeah, hey, different strokes for different folks. As I said before, he's still my idol and he's a billionaire, not me. So, rest in peace. So anyways, the important thing is making sure that you're intellectually honest. So I just wanted to show you this because most people know what happened with Google, that it went up. But again, we're pretending like we don't know that. It's very important. Did I stress that? Yeah. Okay. So now let's go back to this. We're going to share that. Let me move this over for me. All right. So we're going to go back over here, and this is where we were actually buying it back when I was a PM for Bill, and all of us on the team. And typically, as I've said before, there was typically about 10 of us on the team, and we wouldn't really know what the other ones were doing, but you'd hear it through the grapevine. And I think we all bought Google out of this, but it was a nothing at this time. And this was a very important concept. Is Bill would say, if you can't identify the base, you can't trade it. And that was a big, I mean, he would literally pound the table saying that rules, rules, rules. If you can't identify a base, you can't trade it. So when Google came out, like everyone else in the brother, I knew, like, oh my God, this is a huge IPO. Like, it was a big, big deal back then. And one of the things is just the price. There was a Dutch offering, which is a little unusual for a way to price an IPO. It priced out at $85, and then started trading at what was the last $108 on the oh no, $100.34 on the first day of trading. Like, that was kind of unheard of during that time. Most things would price out between $5 to $7, or $7 to $10, or 10 to 12, or maybe 15 to $20. But $85, I mean, that was, and the dollar amount doesn't matter, because it's just a combination of the market cap is a combination of the shares and the price, but it was a psychological thing, really. And this was still back in the day where a round lot is 100 shares, was still in people's psyche. Because back in the day when I started trading, if you didn't trade 100 lots in increments of 100 lots, you would have to pay higher commission. And now people who just started trading over the last, however long, don't even know what a big deal commissions were. I mean, commissions really ate into your trading. And if you had an extra one for when you couldn't do them in increments of 100, that just really ate into your profits. So people would like lower price stocks. That's why when stocks would go up, they would split, a 2-for-1. And it's just like the old saying of, like, you either have a $20 bill or you have two $10 bills. There is no difference, but it was a psychological thing. So just putting yourself, sorry, I'm still sick from that concert a couple of weeks ago. It's actually my worst day, so hopefully I can make it through without coughing too much. But so the high price was one thing, and that is one of the things that I've noticed when I'm skipping ahead a little bit, but with my IPO study, the higher the price, typically the better the performance. So it had a high price, ran up from $85, which is down here, up to 113, which is here, and then went sideways for 15 days. So what type of base is that? That's a freaking nothing. That is a nothing. Well, it was a nothing until I invented the IPO base, which this one was based off of. But go back to the last episodes, I talked about how the PM staff, we could not trade a stock unless it was on our NESME list, or new stock market idea list, that I ended up pretty much just doing with Bill. But during this window of time, there were pretty much three of us that were the primaries to help him out, me and two other PMs, and eventually just ended up being the two of us for almost all adds and deletions on that list. And so we would all want to get names on the list that we wanted to trade. Otherwise, you could trade it in your own account, but you couldn't trade it in the firm account, in Bill's account. So one of the guys told Bill, Bill, this is a high type flag. And Bill bought it. And I claimed BS on that. And I've claimed BS ever since, because Bill would say, rules, rules, rules. I taught seminars with him, and he would pound the podium, rules, rules, rules. You've got to know all the little details. And then when we would talk about high type flags, he would say, it can't be 99% of a flagpole. Flagpole is your run up from your $85 up to here. That has to be 100%, not 99%. In his mind, it had to be 100%. And no exceptions, no excuses, no alibis. So that's not a high type flag. I don't care how much you want to say that, and, if you do the math from 85 to 113, that's not 100%. But he bought into that. And so I'm like, okay, well, I'm not about ready to tell Bill that he's wrong, that that's not a high tide flag, and traded it. And we all traded it because it was Google. Like you had a sense that it was going to be special, just putting your Peter Lynch hat on. So we all bought it and we all did well. And let's walk through how what I would have traded this. When you have an IPO base, which we'll circle back to what it is, but this is the model. So this is exactly what you're looking for. Shoot, I'll just jump ahead and we'll circle back to inventing it. That you typically have a prior uptrend, meaning you go public and then you move up before you stop. Sometimes it'll just happen on the day that a price is out. Those typically aren't as good, but you'll at least have 2-3 days up to around 5 weeks, 25 days, and then it'll run out of gas, pause, and go sideways and digest. And you really want a tight digestion, which this is perfect at 13%. And the sweet spot really was 12 to 15%. There are exceptions. There's some that are even 50, even 51%. I think eBay back in the day was 51%. Could have been a different one that I'm thinking of. But anyways, most of the good ones are relatively tight. So exactly like this, 13%. And when you form the base, the better ones, again, everything I'm going to say, there are exceptions to everything. And again, say this in every video, this is not investment advice. I'm not an investment advisor. I can't give you investment advice. This is for educational and sleep purposes. Have a hard time sleeping, put one of these on, 15 minutes later, guaranteed to go to bed, go to sleep, or just be bored out of your mind. So with this, the right depth, the right length. Now, the length on these only have to be 10 days. Now, there are some exceptions where it's like 8 or 9 days, but the way I programmed it in Pattern Rec was at least 10 days. And that was a huge deal because Bill would say, this is before he came up with the flat, the square box, which was kind of like a flat base, but could be 4 weeks long. The length of a flat base, the shortest base at that point, had to be 5 weeks or 25 days. So it was just unheard of to say that there was a base that was 10% or 10 days. It was kind of sacrilegious at the time, but we'll circle back to that later. So this was 15 days there, and it breaks the old highs. That's your standard pivot, your high. So let's kind of start at the beginning. Company goes public, initial public offering. Same thing with a spinoff. It's a new instrument. Spinoffs are the same concept, but typically it's IPOs. That you go public, you have an initial run up, preferably less than 25 days. Then you pause. Then when you go back above your area, your highest peak, that's your standard pivot. But I like alternative pivots. And so we're going to blow this up a little bit and kind of go through. When you see a pattern and it gives you some areas of resistance, you can buy early, or at least I buy early. So if I were to put myself back in these shoes, and it was already on the list, but I don't think it got on the list until this day or this day, that with this resistance there, I could buy some, and then I would really kind of use the low from the day before as an initial stop, and the low from the day before that is a final stop, knowing that, okay, it didn't work out. I've got to back away. So I'd buy some here as it's moving up. I would add, because now I'm up on the stock. And then my next level would be, let me clean that up a bit. I'll even blow it up more. Right here, because you got to look for where the resistance is. Yeah, I know there's resistance here, but it feels like there, which gives you a little bit of a head start. And why it feels like that is you've got this high here that ran out of gas. You have this high here that ran out of gas kind of on the second day, closed around there. And then this one just poked up above it. And since we don't have the intraday, you don't know how much it poked up above it. So, shoot, I was just looking over to make sure I hit record. Man, I'm not good at this stuff. So that's where I would say your area of resistance is between this level and this level. So through there, I would be adding to it, and it's also taking out that high there. Now you've got a pretty good cost basis in there. And granted, this one down here, that would have been small. Like when I do shotgun things, it might be like 2.5% there, but I'll reverse pyramid. I know that the concept of pyramiding is you start off with like a 50% of whatever you're going to do, and then it goes up a little bit, you buy another 30%, and then goes up some more and you buy 20%. That's fine. That's the way Bill taught it. I just do it in reverse where, I'll buy a small amount, and then if it's working for me, I'll add more. So I might start off with 2.5% here, it is going up here, might make it a 5% or 7.5%. By the time I get up here, maybe I'm at my target goal of like 15%. And that just varies depending on how I'm doing, how the market's doing, how much I like the stock, and all of that stuff. But just trying to put some numbers to it. That might be way too much for some of you. It might be way too conservative for others. So you've got to figure out. Maybe I'll do something on the benefits of reverse pyramiding versus pyramiding, as well as the drawbacks to it, because there's no perfect thing. So by this time, I've got a decent cost basis. Now it pokes up above it, and then I could really add heavy. Now I don't like that close. Like that is a closing range, which you can see in the track price there of 45%, and that shouldn't happen. So that's the only real flaw there. But as I noticed with a lot of IPO bases, that does tend to happen. It's just, I don't know why, but it does. Just one sec. So now that's where, from memory, all this is always from memory. So if I'm off by a little bit, forgive me. It's not intentional. Then, oops, wait, that wasn't, where were we? September. Oh yeah. So let's go out one day. So now this is not that bad of a day. It, you go up, how much you would go up? 1.7%. And, but you close mid range. So it's not really like thrusting the way you would expect and how you think of Google, but it's also not doing anything wrong at this point. And so how I would look at this is once it goes through your standard pivot, is it should stay above your low of that pivot day in most cases on a closing basis. So if it were to go back below that, I would start backing away from the trade. Now let's go out another day. Okay, finally, now it starts kind of moving. Now you've got a 3% move. Let's kind of zoom out to see this a little bit better. So we're 4% from our pivot. So you're still within that 5% zone that the Bill would say that, from a standard pivot with that 5% that you're defined to buy it in. And that's why I shaded this area in blue with pattern rec. So you don't have to do that calculation. And then down here in your loss area, that's, 5 to 8%, but I'll do a whole one on that. So let's go out another day. Why do I keep doing that? I don't know why it says 21 there. Okay, so we're going to go out to that next Monday. It's building on itself. So at this point, you should have your max position that you want at this point. So that's why it's very important to know at all times what is your absolute max size position, and then you back into it from there. So for this series, I'm just going to go with a 25% as your max position. Like sometimes that'll be higher for me, sometimes lower, but 25% in almost all cases should really be an absolute max. But that's crazy if you're new. Like if you're new, don't do 25%. That would be bad. But I'm talking about for people who've been around the block a bit. But that is your ultimate level. Then you've got to back into it and say, okay, out of a standard pivot, how much would I want as my max position? And so maybe that's 15, 17%, because you want to have some ammo left if it gives you some good entry points. But given that it's an IPO base, it's a name that you understand, came out public with, I forget who the underwriters were, it's probably Goldman Sachs or Morgan Stanley or combo. And typically the better the underwriter, the better the quality of merchandise. Because just think about it, you're going public, and you're a run of the mill company. It's going to be hard to get one of the top brokers. That's going to be for the lower tiers. Not that there's anything wrong with them, but just the lower thought of as lower tiers. But the Goldman and the J.P. Morgans and the Morgan Stanleys and stuff, those will tend to have your best merchandise, at least historically. So it's got all that going for it. So you're thinking like, what is the max? And so as you go through this, that's what you should be asking yourself right now. Forget what I say. This isn't about me. This is about you and helping you and figure out where would you buy. Now, some of you might just say, I don't like IPOs. Well, this isn't the video for you. Watch a different one. But if you do, you're open-minded to them. What is your amount? You could say, you know what, with an IPO, I'm not going to trade more than 7.5% in it, period, no matter what, because I've seen so many of them fail. Hey, no problem there. But just have something. So our first down day in this whole way, and this is what kind of gets me, is I'll hear a lot of people say, oh, I can't buy it up here because it's gone up for 1, 2, 3, 4, 5, 6 days. It needs to pause and consolidate. Come on, look at some charts, man. This happens all the time where you run up, and if you're waiting for that pullback, it doesn't happen until up here. Now, at this point, you're saying, oh, well, now it's extended. So study charts and you'll see. So that's inside day. Now, this is beautiful. A little mini upside reversal because it shook out below the day before and closed up. So it's acting normal. No reason to add or subtract. Is moving up higher faster than you would have thought. Really would have thought it would have tightened up and stayed underneath your most recent high longer, but it didn't. So that's telling you something, that everything that a stock does is a tell, and you just got to pick up on it. So that's showing that people are trying to get into this, and there's just not enough supply there. Now you get your first real bad day, and so this is going to spook people, especially if you got your swing trading hat on. I'm reducing here, but with a stock like this, with an IPO base, I'm not going to have my swing trading hat on. I'm going to be doing my position trading hat and just thinking, okay, what should I expect? I've got a downside reversal, big spread, closing at the lows. If I'm a bear, I'm going to try to push it under there and then see what ends up happening. And we also know that, half the stocks will come back into their pivot area over here. So this becomes a reality check day, that if you've gotten ahead of yourself, maybe we talked before that, the max position at 25% ultimately, which would be like, weeks down the line, and you've already pushed it up to 25%. Now you have a downside reversal. You've got to ask yourself, okay, am I going to be able to handle it coming underneath here with that full 25%? And if you can't, then back away down to that level. So maybe you bring it down to 17.5% or some level where you're saying, and you can just put the numbers in Excel and just go, okay, if it comes down to there, this is where I'm at. I'm a little ahead of my skis. Let me just back away to feel a little bit more comfortable. Nothing wrong with that. Okay, let's go forward a day. It comes in. Really was expecting worse, but and again, I used to know this one like the back of my hand, but I haven't studied Google in at least a decade. So this is all still new to me, remembering that it goes way up, but all the details don't have. Wow. Okay. This is a huge tell, because when you come down, especially 2 days, this is very normal and natural. Let's just go back. You're closing near the lows. Excuse me. Your expectation is a move down here and then closing back up here, where I would have hit the gas super hard because then it shook people out. That would have been normal and natural. You go out a day. This is abnormal, but good abnormal. So abnormally strong because it gaps up when it should have gapped down or moved lower. So anything that you would have sold on this day, um, you're looking and saying, well, I've got a big decision here. This looks like it wants to go higher. Was the amount that I had originally the right amount, or should I just stay with, easing off of those? Really, the answer is typically somewhere in between. So let's say you had pushed it too hard up here, 25%, and you were like, oh shit, this is bad. Sorry for the language, not intentional. That you know, and you brought it down to a 15% position, which was maybe a little bit more than you wanted to. Now it goes up because you were hoping for an upside reversal to add at a lower price. You got to be willing to just say, you know what, 25% was too much, but I'm going to go with, I'm at a 15% right now. I'm going to put it up to a 17 and a half, once it takes out that high. And that's how you want to look at it. What are those levels for you? And as you go through this, be taking notes, of what you would do. Not what I say, what you would do. Now it goes higher. We'll go through this a little bit faster. Just looking for something inside days. Yes, it's down 1%, closing at the lows. Totally normal and natural. Where would normal and natural be? Eyeballing it about here. So that would be from this move to this move. Actually, more about there. Well, let's see what happens. Oh, I keep doing that. Okay, we were there. Okay, this is where we were. So we were saying normal, natural, ballpark. Let's see what ends up happening. It just keeps wanting to move higher. Again, that's a tell. When it should come in, it's not. Just another reason to try to make it even bigger. But you're looking at your cost basis and trying to not push it up too much. But I know me. I'm up to my eyeballs. That's my problem. I build it too quickly. um, you know, and so I'm looking at this, and as I'm going through this exercise, I'm thinking to myself, what rules could I implement to slow myself down? And probably that it's time based for me, because I just want to have the biggest bet I can as early as possible, because I know if that works out, what the potential is. So now this went up 22% within the 3 weeks, or the 15 days. That's what that flag is about. That's a rule that Bill came up with when he was trading Certainteed in 61 and was shaken out of it. And then he did a post analysis and said, okay, if a stock goes up 20% within 3 weeks, and there's a bunch of caveats around it, but it's a little bit more complex than the rule than you would think, but goes up 20% within 3 weeks, he's going to hold it for 8 weeks unless he round trips and then he's down on the position. So it's just a sign. I used to use it religiously. I don't anymore, because that's on my to-do list to adjust it for ATRs and study it in a different way. But anyways, it's a solid rule. It just, I think it could be improved upon. I'll do that when I have time. But anyways, he would say, hold it for 8 weeks. And that really worked for him, because he would then just have it on autopilot and not get shaken out when the bar looks bad. And that's something I mess up all the time, is like a bad bar, and I'm, scared. And I sell too much. So a lot of my stuff is trying to not sell too much on some bad days, and also not get in too quickly. So think to yourself, well, that's what Webby's problem. That's just my problem. It's not your problem. What are your problems? Write those down, and think of, that's why we're doing this exercise, is to go through and say, okay, well, what would you be doing right here? Would you be selling the whole thing, saying you're up 22%? You're going to, feed the ducks while they're quacking? There's nothing wrong with that. What's your style? How are you going to get back in if you sell it? Okay, it's coming in, so down 2 days. And again, you want to have an expectation. Where would be normal and natural? through there. Looks like a give me that it would come in to at least there. Let's see what happens. It doesn't. Again, every time that it should come in more, I mean, but this is normal. Down 2 days, upside reversal. Very classic as it gets. So with this, I'm adding, if I have any room left, I'm adding on that day with a stop on those additional shares here. So let's say you've got from this point to up here, you've it's a 20% position, and then you make it a 22.5% position on this day. So those that 2.5%, if it undercuts that, you back away from those shares. It doesn't mean you have to back away from the other shares, not necessarily. Okay, now it gaps up, so that was a good buy. Nice little upside reversal. Let's just go out. Keep doing it. It's just powerful. So this is why I've seeing ones like this. This is why I fight myself and typically buy too much too quickly. All right, so let's go forward. A little downside reversal. What is our expectation around there? 2 to 3 days around there, maybe down there, but that would be a little bit of a character change. So somewhere in there. Oh, okay. Finally. Okay, this is our first like little character change. Notice 5% down on the day, closing at the lows, a bit more than what we would have expected. So let's do a three-dimensional chess and see what's going on with the market. Well, the market's running into trouble. It's been underneath the 200-day, got up to the 200-day, that's this line here, and now is running into trouble. Let's do, since we looked at Apple last week, what's happening there? Wow. Apple's running. Again, if you haven't watched the Apple episode, I'd go back and watch that. So, bit unusual. Highest volume. This is back when volume mattered. So now you're thinking, okay, looks like it's going to. I honestly don't remember what happened. That it's going to come into about there, but I'm a little concerned. So if I added anything on this day, which I probably would have, I'm going to back away from those shares. I might even think about backing away from the shares I added here, because, and that's a technique that I learned from Bill, is he would sell his highest costs first to protect his cushion. And there is no one remotely like Bill with his cushion. So his cushion would be whatever his cost basis is. Let's say his cost basis is here. And then let me clear that out. Let's say his cost basis is up here because of adding to it. Well, he would sell on it, on this type of action, he would sell any of the shares that he bought up here, to reduce his cost basis to more like this, so he could sleep at night and then always be willing to ramp it back up. So it's not like you just set it and forget it and you just pile in and just fly blind. You're going at it with you're going in and out of, but not all of your position. You're trying to think how much would you, and let's see what ends up happening. I mean, the next day should be bad, but maybe it's not. This is the day I kept going to. I should have known that. Wow. I'm not trusting it yet. Even though I think it goes a lot higher, I think we saw that it gaps up or something. That's, I would have to know the context of, was there news that was driving it down and everything? But it looks like when you have that type of volatility, what would be normal and natural is to stay in this type of range from here to here for some amount of time. Now, I don't think that ends up happening, but just being honest with myself, it's been all over the place for the last 4 days. I want to settle down before I add more. I'm certainly not selling any. Now, if I oversold and overreacted, I might buy a little of that back. But let's see what happens. Wow, massive gap. So again, I think I knew that it gapped at some point, but I didn't want that to influence my what we were doing with this exercise. Because if you would have said to yourself on this day, oh, I'm loading up, and you could make an argument. saying the same thing that we said, over here, where it had that same character, down 2 days and a gap up, and then you move higher, down 2 days, and then you have this abnormally strong day, up 6%, closing at the highs when it should have been down. You can BS yourself and be like, oh, I'm going 100% long that day. But that's because your subconscious has in your mind that it saw that chart. Like, I kept on going ahead and seeing the charts by accident, but I really closed that out of my mind. Like, again, that's the most important. If you don't get anything else out of all of my ramblings, intellectually honest with yourself. So now, okay, you got this big gap up. It must have been news or on there. Let's see what's going on with the market. Wow, it's even more important. The market failed at the 200-day and is down 2%. Let's see what Apple is doing that day. Apple's holding in tight. All right, so what are we going to do? I know my instincts when I'm in a stock and it gaps up. My only question is, how much am I going to buy? I have some good friends who would see this and they would just be selling into it, and they do great, but it's how are you wired? So let's say we were at 17.5% the day before invested. Now I'm afraid that it's going to doodle around up here for a little bit, and maybe come into 160, which would be normal and natural. So I'm trying to see how deep in. So in a perfect world, I'm just going to go to 20%. But I know myself. I go to max. I go to 25%. Come on, who's fooling who? But I'm trying to learn. So we're going to cap it. We're going to cap it at 20% here and let it give us another entry. See what happens. And it just keeps going higher. So I can't add there. Can't add there. Can't add there. It's starting to tighten up. Okay, now I can finally add because we have something to trade against. It's gone up. It settled down for 2 days. Now, if I add here, I can back away from that if it comes into here because that wouldn't be normal and natural. And so let's go out one. Okay, now you're up and you got a little downside reversal right at 200. That's a bit problematic because it should have gone higher. So whatever I bought there, because it was, like let's say we were at 20% and made it 22.5, on this day, I'm really keeping a close eye on that. And on that day, I might even sell some on that downside reversal, assuming it's going to come in here, maybe base build. But certainly through here, the low on the 28th, I've got to start backing away from some of it to protect my low cost basis stock. So let's see what we've got. Wow, that tightened up, but I'm not going to buy it back yet because anything that I sold, if I sold any, because it hasn't given me enough evidence yet. So let's go forward a little bit. It's tightening up. 200 is clearly in a resistance problem for it. Okay, now you've got a downside reversal after it's starting to change character. Notice how I had no problem, had a downside reversal 2 days later, it's higher. Downside reversal 2 days later, it's higher. You go down 2 days, you gap up. Now you're going into new high ground, you get turned away. Tighten them up, which is helpful. Then you hit the Livermore 200 number and you get turned away. That's not normal and natural. So I'm going to be selling any of the shares that I would have bought, really anything over this area. I'm trying to get my cost basis lower because I'm expecting at least into 180. And look what's going on with the market. The market's shooting up. So sometimes when the market's going into trouble and then it firms up, the ones that have been working, people sell into those and rotate into the stuff that wasn't working. Let's see what Apple was doing. Wow. Let's see what Microsoft was doing. I was kind of a dog during that time frame. What was another? Was Baidu trading at that point? Okay, let's go back to Google. Oh, jumped ahead by accident. Oh, shit. I didn't want to see that. I didn't even know that. Oh, well, that kind of ruins it. Look, we still thought it was going to come in. I am completely purging all that information out of my head of what we just saw, and we're going to look at this with 100% intellectual honesty. We just talked about how this is its first character change, and we think that it's going to come into about here, and now the market is ripping, and it's not. So again, anything that we've bought above here, we're selling and getting ready for a 180, literally 180, 180 price. So it's coming in. So that's what we expected. So that's why we sold on this day to keep from selling on this day. So if you sell a bunch on this day, when this happens, you don't have to do anything because you were expecting that and you've already adjusted the day before. Now, if you look at it and you go, well, I haven't done enough selling, then you could maybe sell, some of the shares that you bought above this level. But let's see what happens the next day. Okay, that's not good. That's total change of character. Your biggest day, so here, this day was up 15%, but this day is down 8%. It's your biggest down day. This was down 5%, down just like a percent over here. So that's problematic. So now the question is, what do you do with those shares? Let's look at it on a weekly. This is a Friday. Okay, so you've had this huge run, up 49% in 8 weeks. So this is the end of your 8th week. So with Bill's concept of the 8-week rule, you could just lock those in. So Bill could certainly, and you can see how well that rule worked out on this 8th week. Doesn't mean you sell on the 8th week. It just means you hold through that 8th week, and that is the genius of that. A time-based rule keeps you through a lot of noise. And you've got to decide, am I going to sell this or not? So what I would do is utilize the RS lines with the moving averages. We don't have enough time on here for it to have the longer term moving average, but we do have this one here, which is our 8-week. Again, we just go over here, relative strength lines. This is our 8-week. The 21-week isn't on there yet because we don't have enough time. Let's go to the daily. And on here, this is our 21-day, this line right there, and this is our 50-day. So the question is, how much are we going to sell and how much are we going to hold? So we have 3 days down, accelerating lower, definite change in character, feels like it needs to base build. And we have our RS line rolling over hard, going through at least one sell signal here on the daily. So the question then becomes more of a fundamental one: is what is your price target for this? Is something we used to do back in the day. Used to do it almost every day for my holdings, and it is really it was a mathematical way of trying to figure out what's the potential. We'll do a video on that. But with this one, this is really tricky. We know what ended up happening, but we've got to be intellectually honest. I'm probably blowing out. I'm blowing out everything that I can that I bought over here, over and above this. That's what I should do. I'm not sure what I did in practice, but because this now looks like, let's go over the weekly again. Down 11% on that. Let me see. No, I'm not going to do that. That's a real quandary. How much to sell? Yeah, I would say anything that you bought above here, and then I'm wanting it to stop by there, but also knowing that there's this time element in there. This is really, really hard of knowing, because why it makes it hard is because we don't have enough time on there to use the quicksand Grateful Dead rules for all of these things. Now, again, this is your quick. Let's go back one day. Your quick is when your RS line, the green line, goes through here. If we were using it on using the daily rather than the weekly, if we're using the weekly, it's all the way down here before we have our first sell signal. So we're trying to utilize these. So we want to hold. Let's go forward one day. Yeah, we're gonna sell down to anything that we've bought offensively. So again, let's start at the beginning. I'm sorry, I'm just being honest with myself, and I'm trying to learn from this, not just say something that would make me look good. Is 25% is our max. We don't want to. We know we don't want a 25% position. We have a low cost basis stock from all the way down here, and we know how precious that is. So we don't want to blow out all of that. So how much do we sell? So I guess when you're not sure, you want to go back to your rules or quicksand Grateful Dead rules. That is, you're allowed to sell down from your 25% down to 15%, and that 15% is your core in our example, with selling 5 of that percent there, another 5, that's our quick. If this RS line goes lower than there, and we sell another 5%, meaning we've sold 10 of our core, so we only have 5% left until that RS line goes through there. So that's what you're going to have to do. You're going to just have to follow your rules, even though they're not perfect. Not perfect meaning we don't have a lot of history on here with this moving average, because it's only about a week long. So let's see what happens. Okay, it's holding in there. The RS line goes back up. So again, we still have our 10% position. So again, 25% was our max. We sold down to our core position, which is a 15%, and we're doing those in 5% increments. A quick is selling 5. Quicksand with the RS line going lower than this, which it hasn't yet, would be another 5, and your last 5 is here. All right, let's go through. So it's lower, and your RS line moved lower. So now, even though it looks like it's finally getting some support there and holding there, we've got to sell another 5% because we're following those rules. So now we only have 5% of our stock. Let's see how this plays out. Holding in there nicely. It's back up. You can add back to it, but really, why? Like, what rule? Or it's finding support at the 21 day, but really it looks at an awkward position there. But let's just see what ends up happening. Now it's stalling out. And by awkward position, just meaning it came down so much to get down to your 21 day, it needs time. Let's just go out a week, because this is dragging on. Goes lower, which is normal. This is just base building at this point. Our RS line is still above our 50, so we still have our 5%. Go out another week. It's firming up. It's starting to look good. Our RS line is back above here. It looks like it's rounding out. Let's go over to the weekly. Oh, that looks nice. Just your first pull back into our 10-week line. Let's go out another week. Oh, it's holding in really nice. So now you're looking at it saying, okay, downtrend line there. If it breaks that, even if you don't add to it, it should move higher if it's healthy. Let's see what happens. It doesn't even go above it. So that means that's giving you feedback that there's a problem there. But it still hasn't triggered our Grateful Dead rule. We're still holding on to that last 5%. Just rounding out the right side. Go out another week. Rounding out the right side. That's good. Now you could have added some there. I don't know that I would have. I probably did add to it there in real life, but even knowing that it went higher, it just wasn't acting great. But let's go back to it and see. 21, 20. Yeah, no, it went over this marked high. When you take out a marked high and the RS line is back up there, that's a legitimate buy. Now, these marked highs, the 183, those are genius that Bill put those in there. It's very, very simple. I'll do a one on those. One of my favorite things that when you, and I don't think that he came up with it, but he recognized that how valuable they were, that it's 9 bars on each side. So this 183 is telling you that there's at least 9 bars on the left side that aren't higher than 183, and at least 9 bars on your right. Could be more, but at least 9. And then that's where we mark them. Same thing with the low. Your low down here, 160, 131. you've got 9 bars on each side. Those are gold. I mean, so good. The simpler, the better. So, not what you would have expected after going through a marked high, frankly. Tightening up, that's better. Let's see, right around Christmas. Right before Christmas Eve, this is what I call a setup day. And, uh, setup days, just something that, again, another one of my uh, things that I came up with is when it looks like it should go higher, and there's no, it when you see it. One of the things is a tiny spread closing near your highs on the day, right up at a resistance area. It can be a horizontal resistance area, it can be a downtrend, really where your clear expectation is to move higher the next day. And I will add on a setup day late in the day. Let's see, no trading there because of the holiday. Then it gaps up, what you would think. So I would add to it, holding in tight, moving up, but it didn't really have it's kind of a wedgie type of feel. So you don't really need to add there. Then you've got a downside reversal. So now your expectation is a handle. As you round out the cup and you're going up near your old highs, your left side high, that now it's doing nothing wrong. Your expectation is a handle. So that means anything that you bought there or even bought here or here, you might back away from, because a normal handle would come into about here. And do you really want to give all that back? It's when it does a downside reversal like this day, look what happened this downside reversal. Well, here is another one. It kind of stopped it in its tracks. It didn't go down, but you have another one here and it goes down. You have a downside reversal there and it goes down. Downside reversal there and it goes down. So our expectation is we at least go lower for one day, but really it should base build here. So let's go out a week. Um, Normal, natural, just forming a handle. That's why, shoot, I missed today. It was up. Okay, so now stronger than you thought. Downside reversal. Your expectation was for it to form a handle, and it doesn't form a handle. Now I know I jumped ahead, and we know that it formed a handle, but we've got to be intellectually honest. Your highest volume in months. It is very tricky the first day of the year, but still, I'm buying. I'm buying a ton of this because it's a base breakout, and I know I was buying a ton at the firm, and I think we all were. At least that would be my assumption. I don't know why you wouldn't buy it there. There's no legitimate reason. Up 5%, cup without handle. Yeah, and then let's see. All right, problematic. So anything that I would have bought here and I would have bought it heavy, I'm backing out of that on this day. That sucks. But you're down 4%, and more importantly, you're closing underneath the low of your breakout day. And this is another one of my, I can't keep on going on these tangents, but another one of my inventions was um, the breakout buying and where to sell it. And I think I touched on it a little bit earlier, but it's a definite sell when you close below the low of day one. And this is what's called day one, your breakout day. And then day zero, the day before the breakout day, a close below that. And then you basically sell the balance there. So let's go there. Did that close? No, it just traded below it, but didn't close below it. Okay. So now at this point, that's a base breakout failure. Once it's underneath day zero, which is this day, December 31st, anything that I would have bought up there is gone. So anything that I bought there is gone. And I'm back to my original core, you know, um, core amount. So at this point, remember the rule for using the quicksand Grateful Dead is it's only on shares that you're up on. So you can't say that, okay, you bought it over here, right? Let's say we had a 5% position, until here, until this. Let me clean this up. You had a 5% position until here because remember we sold sold it down on this day and this day down to a 15% on this day because the RS line went through its moving average. We sold it down to a 10% because that was a quick rule. Then on this day, the RS line went lower, so it was a quicksand rule. So now at this point, we only had a 5% position. So that would have been our 5% position with this low cost basis. So now, as we're adding to it up here, you got to be honest with yourself. You only had a 5% position, and you bought all these shares up here. So now you're not up on it enough to really implement those RS line rules, quicksand, Grateful Dead rules on those shares, only on your original 5. Now, if this is new to you and confusing, it should be confusing because it's going to take you a few passes for this to make sense, but you might want to go back and replay that part afterwards. So now we're just down to our 5% position, original core. And look, it holds up there better than what we thought. Let's just go out another week. It's holding in there. Now it's forming a prior resistance of through a handle in here. Not the most beautiful one, but I'm going to add to it there. RS line is poking up into relatively new high ground there. So I'm adding, maybe I'm putting that up to a 15% position. Let's go out a week. And it fails on us. And so this one, making a 15% from a 5% position there, probably adding to it I know I'm adding to it on that day. But then, look, here's our day one. And so we're closing back below that on here. So it's certainly selling some there, but this one, with a close below that, even though it's day 2, you're still selling some. You've got a second time going into new highs, having trouble at 200. The RS line is starting to roll over. Let's look at what the market's doing. Oh, shoot. Google actually looks good compared to what the market was doing. Let's see what Apple was doing. Well, Apple was doing well. So this is a bit problematic because it's tough. It really was bucking what the market was doing. Now it's coming down even faster than it was. So now you're down, almost 3%, and it's accelerated from 3% here to less than 2% here. Now it's picking up. So again, you're out of everything that you bought except for your original 5% down there. So this is the reality. When you see it on a chart and you're saying, okay, just buy it here and then sell it way up here 5 years later. How? And you have to have, and then if you have a rule for that, then fine, go through this process and test it out and see. If you got a better rule, use it. So now at this point, it failed from there. So at this point with breakout failure, you're out of everything except for your original 5%. And then let's go back and see what day that triggered that. So on the 25th, this is your final sell of your last. It's hard to sell it, but it's a base breakout failure. And look, we had, sometime around here, we took it off the list. All of us were out of it too. So I don't want to hear, otherwise. So let's just go out a month, speed this up. So it's base building in here. Oh, you poked up into new highs, but let's just go there. That doesn't really look right? Because you have this base that had all these problems. You have this base breakout that fails, and then it's coming up, kind of a little wedgy, and it's gapping up there. It's on massive volume. I'm not saying I'm not buying, but it's not a good setup. It's not something you're going to get carried away with. So maybe 10, 15%, but not 25%, because you're out of it. So I'll start at the beginning. There was no reason to buy it until that gap up. So no, not even doing 10, 15%, because you're completely out of it. We'd sold our final shares there with the Grateful Dead. So you're out of it. So really, with a gap up like that, and I talk about it on IBD Live all the time, out of position, gap up probably on news or earnings, that you're looking at a 2.5%, kind of shotgun approach, hoping that it goes sideways here. It tightens up, maybe has a shakeout, and then we can hit it hard. So let's see how this plays out. Looking good. Might add to it there. Not enough to sell it. That's fine. You're down on it. Certainly down on it because it's down anything under there. So, but yeah, maybe 5% position goes to a 2.5% position. Now you're out of it. Okay. Anything you bought on here, there's no reason to hold it unless you just want to experience hope. Hope is not, good thing. Firms up, frustrating, but it's reality. It's just going lower. You're not in it. No reason to go in it. Let's go out a week. No reason to buy it. No reason to buy it. Let's go out another week. No reason to buy it. No reason to buy it. So on. Let's just go out. Okay. So we talked about it on the Apple, the story. I won't go into it again of how we put it back on the list, the Nesme list, so we could buy it because we removed it from the Nesme list somewhere over here. I don't have the exact date because I don't have those old books anymore, but we put it back on somewhere around over here, and we're buying it. I think we were buying it here or here. But let's just say the Nesme thing wasn't an issue. Where would you be buying it? Your first day would be buying it here because you've rounded out this base. It's not truly a handle because it's in the lower half, but it's just this little ledge, and then it's gapping up. So your expectation is for it to go higher. And I think I said on the last video that this was one of the biggest mistakes I made in my life. But I made a ton of money off of it. I put 50% of my account into it. It was either on this day or this day from memory, because the way our rules worked at the firm was you only had once it went on the list, you had to wait 48 hours before we could buy it ourselves because we had to let the clients, the Fidelities of the world buy them first. Then we would have one day if of those 10 PMs, two or more of them bought more than X number of shares. I think it was 25 or 30,000 shares at that time. That then they controlled that stock, so they could add and subtract from it as long as they kept above their 25,000 shares. And it was like the top guys who had those or that position. Anybody underneath that couldn't control it, so you were blocked. You had your one day to buy it, and then that was it. And you were done until they decided to sell it. And when they decided to sell it, you didn't want it anymore. So I put 50% in there from memory and got away with it. And then it reinforced this habit of going too big too quickly. So the reason why I bring that up is to just remember, if you put on a trade and it goes against you, doesn't mean that it was a bad trade. You put on a trade and it goes for you, doesn't mean it was a good trade. Doesn't mean you followed your rules. So, I broke my rules. It was a legitimate reason for it because we kind of made things a game within a game with all those silly rules. But the reality is I still shouldn't have broken them and gone so heavy in there. But I got away with it, and it's to this day has created a problem for me of going too heavy too quickly. But we're going to pretend like that wasn't an issue. We're going to be buying some here, buying more of it. We're going to buy some here on that gap up as it's rounding up the right side, adding to it here. Then you get a major gap up going through a cup without handle. We're buying even more here. Let's see how this works out. I'm not even sure that this base works out, frankly. But still, you're adding heavy. Now, on this day, I'm going to add more because look how tight that got. Let's go to the second. This is, again, kind of a little setup day. We've gone and formed this little shelf. And I just call it a shelf because there might be some other name for it. But the way Bill is he wouldn't allow us to use outside jargon. And I was going to share this later, but I'll share it now. Here's some books that he absolutely hated. So here, I'm going to stop share. Let's see. So this was Edwards and McGee. Oops, that's upside down. Where is it? Oh, I guess I just see it backwards. So this is thought of by a lot of people like the Bible in technical analysis. Bill hated it. I wasn't even like once he saw this, I took it home because he was not a fan. And if you use any of the terminology in here, he would not be a happy camper with you. This one I actually liked better. This was Pring. He never really talked about it, but they all kind of are in the same camp. Technical analysis explained. Um, and then this one, oh, John Murphy, yeah, good stuff. But again, he hated this one too. And technical analysis of futures markets, but it's really for all things, and very detailed work. And I don't have anything really negative to say about him. It was just Bill wouldn't allow you to use them, which is why kind of forced me into coming up with all my own things. And why I've invented so many things is because unless it was Bill's way, it was the highway, man. Like you could not um, use things like Bollinger Bands or candles. Even though I used candles, he gave me a hard time for them. That's kind of a funny story. Maybe we'll get to it later. But the one book that he would allow, that he said good things, was this one, this old uh, book, if you can see that. Um, this was impossible to get back then. The Schabacker book, Shabacker, Technical Analysis and Stock Market Profits. And it's probably, oh my God, I kept this in here. This is, oh, I don't know if you can see this, but it's for my daughter when she would sometimes make me lunch and stuff, and she would put these things. What a sweetheart. That's her nickname, Lala. But love you, Dad. Love Lala. What a sweetie. Um, but anyways, this was back from like these olden charts. Uh, you know, when was this? Probably the 20s or 30s. But it's a good book, really good book. And this was expensive when I bought it way back when. 19 Second edition was 1937. Oh, 1932 is when this came out. So he was fine with this one. So I was good to go. But the reason why I brought that up is, let me go back and share this screen. Let's see. Um, this is what I've just coined a shelf. I don't even know if someone else has. It's been so long since I've read those other books. I read those in the 90s before I was working directly with him. I haven't read them since. Maybe excerpts of it in places, but I don't know if I invented the term shelf or other people have. But I just started calling these things a shelf because we would break out of some sort of structure and hold in tight. And I'm like, it looks like a shelf to me. And I would just call it a shelf because Bill couldn't get mad if I called it a coil or a penton or, you know, asymmetrical triangles and broadening formations, all this stuff. He would just shoot me. So I just came up with my own lingo. And that's, yeah, that's where a lot of my things came from. It was frankly because he wouldn't, he just wouldn't allow us to use other things. I mean, it is what it is. We all have egos. I have one too. So now it breaks out of the shelf. I'm hitting it hard because the day before was a setup day. Again, something that I coined. And then it breaks out of there. So you're hitting it hard because your expectation is that it's going to go a lot higher because that would be normal and natural. And if it were to come back in to here, you're backing out of that. So I know I go off on tangents, but the point is you should be looking at this and forgetting what I'm thinking and just thinking, where are you? Are you short? Are you long? How long? Of course you're not short. Um, are you long? How long are you? And I'm thinking to myself, I started buying it here, added to it here, added to it here, probably added to it here, certainly added to it there, added to it heavy there. I'm probably 20, 22%, knowing that my max is 25. So again, that's my problem. I'm going in too heavy too quickly. And so I should probably dial that back. So let's just say 20% max. Okay. So now It's coming in a little bit. That's okay. Going sideways. Let's just go out a week. It's just a shelf on a shelf, an elf on a shelf, and really constructive. So realistically, I've made it by this point. It's a 25% position because now, if it were to come in all the way into here, I'm backing away from a lot of those shares. Probably all the shares that I bought from this point higher, even really from this point higher, I would sell if it came into there. So let's see what happens. And notice that RS line has been trending above those. Let's go over to the weekly and see what that looks like. So in here, at this point, we've got our longer term moving average on there. RS line is hanging in there. Looks beautiful. Let's look at the market. Oh, the market has turned. Oh, wow. Okay. So that's good. Let's go back to Google. Looking good. Let's go out a week. I really don't remember how this played out. Wow. God, I thought it fit. What? I don't know why. Okay. Beautiful. So you've got your max position in here. Is anyone selling? Like, let's see. Are you selling on this day? Looks like it wants to come in. Looks like it should come into here. Are you selling any? Well, probably not, unless you've gotten too carried away and you're past your limit. Let's go out another week. Looking good. He's not doing anything materially wrong. Your first pullback into your 21 day right there. Nice support off of that. Your RS line has been above it. Really, if you max out your 25% over here, now you're just sitting. Now, my problem is not abiding by that 25% and not getting, on this day wanting to go, like nosebleed level. So I'm looking at this just saying, Mike, keep it at 25, keep it at 25. Moving up, if you've sold any, you've got to buy back there on this day. Big outside day, breaking this downtrend. Excuse me. All right, goes into new high ground, pulls back in. That's normal. Tightening up, holding above your 21 day. RS line looks fine. Looks fine. Huh. Okay. What does this look like to you? So it looks like it's forming an ascending base, right? One pullback, two pullbacks. Now, three pullbacks. It should form to here and then move up, and then we hit it hard here. So ascending base is three pullbacks, about the same size. Typically, your third pullback is a little bit less than your first two, but they're typically proportional. But we know that this now becomes a line in the sand, that with an ascending base, each pullback, three mini pullbacks, each pullback is supposed to hold above the low of your last one. So now we've raised our line in the sand up. At this point, since we're up so much on it, we're not probably not using the daily RS lines for selling in a major way. As far as our core 15%, we're probably switched over to a weekly using those. Let's look at that. So the RS line is above both of those. Yeah, we're up enough that we've switched over from the daily to the weekly. I don't have a hard and fast rule for that yet, but really more of a time element, kind of a combo of a time and a percent. So we're up 39% in 64 days. So, that warrants switching over, but doesn't mean you ignore these. So we were getting a sell signal here, a quick, and it looks like we're getting another quick, but still it's forming this ascending base. And now we have a line in the sand that it should stay above. Let's see what ends up. Ooh. Oh, that's a problem. Let's go back through here. Okay. We're going back a few days. So now this low on this day is 288.51. So let's blow this up a little bit more. So we need it to stay above this for it to be an ascending base. And at this point, it shouldn't go any lower. So our low is 292. So it should move higher from there. Let's see. It's holding in there. It's holding in there. Boom. Okay. Problem. Big problem. What are the problems? Okay. Now it broke our expectation for the first time. It's no longer an ascending base. So if you're getting ready to pounce on it the way I was, I'm going to start backing away from some. But we've got a lot of conflicting things going on. We've got our RS line going through here, which is the quick. Then it goes lower, quicksand. Now it's going through on the daily. It's going through the Grateful Dead, as well as it's broken our expectation there. So now, what's on the good side? It's our first real pullback to the 50-day since it's moved up. So we'll yeah, I'm going to have to sell with the expectation of if it comes back through here, I'm going to be buying some. So I'm selling down to at least my core that I'm using on the weekly. So I've got enough sell signals on here. So let's say I had a max 25% position because of the quicksand and Grateful Dead on the daily. I've sold it down to just that core. The core 15% of the 25 is and that 15 is of the entire account. So you have a $100,000 account, $25,000 is your max position, 15,000 is your core, and we're using it on the weekly. So we'll go over to the weekly. So it triggered that as well. So now we have a quick on there because it went through that, even though it's at your 10-week line. So you've got these conflicting things. Some people would be buying it on the 10-week line. I like buying it on the recovery from there. So what is our position size? What's my position size? If you said 10%, you're right? Because we have 5% that we're not going to sell until it goes through our Grateful Dead signal on here. And another 5% for this, we want that RS line to go lower than where it's triggered this quick rule. And the quick, of course, is the RS line going through there. Hold on, I've got to text my better half that I'm still doing this because she wants to go eat. Hold on, people still rambling. Be done in, oh, who am I kidding? 45. All right. So she's an angel. So we'll go out. We're here. Let's go out on the daily. I should start these earlier before it's lunchtime. Now it's kind of inched up a little bit, just hugging that 50-day. So, people would have been tempted to buy more here. In fact, I probably would have because I was down to a 10% position. Now it's recovering off the 50-day. So maybe I made it like a 12.5% position, but it's still bothering me that ascending base is no longer truly ascending base. So the probability of it just forming into a bigger base here is pretty high. But let's go ahead on a weekly and see what the RS line is doing. So the RS line picked back up, so it's not a quicksand, so that's fine. We've gone from a 10 to a 12.5% position. Let's go out a week. Okay, let's go back and do this one day at a time. Here's Monday. So anything that we bought here, because we didn't bounce, I probably would have been selling it actually the day before. That's a Friday, stuck underneath 300, all these issues with it. RS line isn't really doing anything right or wrong there, but it was breaking our expectations. So I'm the whatever shares I bought there, I'm selling there. Now let's go to the end of the week. Let's see what that RS line did. Okay, it's still hanging up there. So we're using the our core 10%. Let's see. On the daily, I would want to have been out of it, but we've got to use these rules. Okay, let's blow this up. You can see that went lower. Here was your quick, the RS line. Now that RS line went lower than that point on here. So that's your quicksand. So now we've sold another 5%. So now we're just down to our last core. What do we have? 5% in there. And we're waiting for that RS line to go through there. And that's just my rule that I developed out of studying these and realizing that I just mishandle them all the time. It's more of a holding rule for me, so I don't oversell, because that's what I tend to do, is overreact, both on the way in and on the way out. So let's just go over to the weekly and just advance through this a month at a time. Okay, so it never triggered any the Grateful Dead signal because this RS line stayed above it. Let's go to the daily, see what it looks like. So it's breaking out of this base here. So we're going to say that we would be adding to it on that day, early in the day, but then probably backing away from those. It didn't really give you a clear entry. Probably right there would have, you could have bought some. You could have bought some as it was going through the 50. As something rounds out and goes through the 50, I found that kind of like over here, that's a fine buy. Sometimes you get shaken out, but still you could have added some there, not knowing that it wasn't going to be a cup without handle, but buying some there, but automatically getting turned away. So even if you didn't sell some on that day, by this day, you're selling any of those shares that you bought because it's a base breakout failure, but you still have your 5% core position that you had originally. But anything that you bought up here, like you're expecting this to fail. Let's see if it actually does. I really don't remember. Guess not. Let's go out a month. So it goes a lot higher. So let's walk through how we do this. And it never triggered your Grateful Dead signal. So you still have those 5. So that's what we were talking about before, selling it by here. Not really a true entry there, but let's just say you bought it there, you're selling it by here because that's just not right. Doesn't give you any entries. This isn't a recovery through the 50 days, so I wouldn't be buying it there, and I wouldn't be buying it. And even knowing this gap, I'm not going to be buying any until the gap. So on the gap, I will buy. I still have my 5%, but there's no legitimate reason to, let's go back a little bit further, to be buying it, there. Like if you bought it in here and you're still holding it here, why? Like, what are you seeing? And if you're seeing something, write it down. You might be making an original observation, then write a rule around it and test it out. I don't see anything there. So I don't see anything till the gap up. Now the gap up tells me it's time to be loading back up in this. And so again, I'm fighting myself of, I've got 5% in there, and with really low cost basis stock, under 113, what do I do here? How much do I buy it? I almost want to think of it separately, like I don't have any of it and I'm starting from scratch. But then I probably want a 2.5 to 7.5% position because it gapped up and I don't know if it's going to go sideways for a little bit and give me a better entry. So we're going to by 2.5 to 5%. Now it doesn't come in the way I was expecting. So by here, I'm making it maybe, so we had our original 5%. On this day, we were buying 2.5 to 7.5%. So let's just say 5%, to split the difference. So then we're at a 10% position on this day, 10% of our overall account. And so by this day, I'm making it a 12.5. In reality, I'm making it bigger than that, but I'm trying to, walk you through my process of learning this. I'm trying to get something out of this for myself as well. So added to it here, probably added to it here, added to it here. So now the question is, how much do I have? I know I'm loaded up to my eyeballs in it, but let's say I really shouldn't have more than 15, 17% in there. Go out a week. It's not doing anything wrong. Not doing anything wrong. Not doing anything wrong. I mean, really, there were some places in here where you could have increased, but it's really a little bit too much too quickly. In all honesty, still having it under 20% would make sense here. But I know myself, I'd be at 25. Let's go out to my sister's birthday. Okay, so it's that's a little abnormal action, down 4%, but it finds support at the 21 day. But it's kind of a wake up call that if you got carried away and started making it, if I made it a 25% position here and that happens, I'm bringing it back down to a 20% position. And so that's why I don't want to go over my skis, because then I overreact, and it's better to have a lower amount in there that you can hold. I'm talking to you, Webby. Okay, so it's just base building. It's coming up out of there. It looks like it wants to go through this marked high, which is something we would add to. Okay, interesting. We go through a marked high and you get really turned away. That's problematic. It's reminiscent of over here. So this is a wake-up call to dial that back down to maybe a 20. If I had made it a 25% position, because you've got that day plus this day, people are selling into it, plus you have this day, like, a freight train's coming at you, don't look down at the, at the tracks. That old saying from Livermore. So now you're breaking through your 21 day. Like, we've got problems all over the place, right? You've got a kind of a changing character with your RS line here, going back through there. Major downside reversal, stalling action, can't go higher, breaking. I mean, it's normally not one thing that kills the stock. It's a bunch of stuff. And then let's look at what the market's doing. Market's coming in during this, so it makes it a little bit trickier because probably all of your other stocks are coming in at the same time. So now the question is, how much do you hold? We're out 70 days, up 31% out of this base. So we've probably switched over to the weekly. Let's see what that's doing. So we're going to try to hold on to our core. Our core again is 15%. And because it hasn't done anything wrong according to the weekly, but it looks bad to me on the daily. But let's see. Now, moves higher. So that's why we use those rules. I thought we were going to get smoked. I honestly thought we were going to get smoked. But it goes higher. So on this day, so we were down to our 15%, buckling up. I was expecting a test of the 400. So it's stronger now than I think. And, again, we got through the holidays. First day of the year, it's always tricky. But I'm going to buy back. So if I had 15% of just down to my core, I'm going to make that 17.5% there, probably a 20% there. We see kind of how that goes. And you don't have to do any of this trading. Woo, that's ugly. All right, let's go through that. Didn't see that coming. All right, so it's not doing anything wrong. Yeah, you've got one down day, but look, 1, 2, 3, 4, 5, 6, 7 day, whatever it was. That's normal. That's normal. That's abnormal. I mean, a gap down. We haven't had a lot of gap downs during here. Stopping at your 21 day, but it's down 4.75%. Your volume has picked up. This is back when volume was accurate, relatively accurate. Your biggest volume spikes here are on the downside. That's problematic, and we had all this selling in here. So now I'm going to sell everything but my core. So I'm going to go back down to my 15%. Let's go out to the end of the week. Woo! Jeez. I saw that I'd already forgotten about it. I already forgot about it. That's when you do this long enough, you'll just completely be able to tune out. You can see exactly what it is, but you'll be able to tune it out. So the day before, let's go here. So now we've gone through, we didn't find support at the 21 day, but now we're underneath it. But let's see what our rules are on the weekly. So we have 15%. Oh, good. It triggered. I'm glad. So we have our quicksand in there because it's gone so much below there. So now you're back down to just your 5% core that you had bought over here. So we're back down to that again. And let's go out a week. And it holds up. So we still have our 5%. Let's go out. That looks ugly, man. If I was just trading off the chart, I'd be out of the whole thing. That just does not look right. Let's go out a week. Okay. Now our Grateful Dead signal. But we were waiting for that. Even though we saw signs on the chart, it was problematic. Now we're out of it. Now we're completely our first time that we're in cash in this, right? Or did we sell some in there? Sell it all there and buy it back? I can't remember. You could play it back and see. At most, we would have had 5%. So at this point now we're out of it. So we held some of it from here to here. Now, if you can figure out some other rules, I'm not saying there aren't. If you can figure out rules that you can follow, that you test out, that you trust to help you better, navigate through a move like this, use them. Like, don't use mine. Like, I shouldn't have even shared this. Like, this is silly. As a trader, it's kind of like if you're a poker player and you figure out someone's tell and then you go and tell them, like, or you tell the whole world, like, that's not smart. But I'm just trying to help all you guys out. Let's go out a month and see what ends up happening. Let's go out to the end of the quarter. Okay, so the stock has been done. Remember, we sold the last of it over here. Let's go out to the end of June. So, think you get the picture here. Let's go out to the end of the year. Is really never the same. And you can tell that by that RS line will poke up for a little bit. I mean, we could go through that same exercise, but I think you understand what this is turned into, a chop. And that's what you can do is look and see the character of a stock when it changes from the RS line trending above its moving averages to just going back and forth. That's a character change. Let's go out another half year out to the end of June. Again, it's just become just this choppy stock. It's not the same anymore. Let's go out to the end of '07. Now, what's funny is this was his last little hurrah here, starting out at the end of '07, and this was right. Remember we went over in the one of the last ones, November 1st of '07, and how that was an expectation breaker in the market worth revisiting because it was so important. And this is something that I came up with Charles Harris and Justin during the market school days when we were coming up with rules, and we coined this day, November 1st, an expectation breaker. I might just do a whole episode just on those, but we're going to go out to the let's see what Google was doing on that day. So it was just powering higher. So if you were in this one, let's just say we had been completely out of it and we bought it on here. You could walk through that procedure, even knowing that the market's topped. We would have built in a big position in here, and let's just go through this by the end of the year. So it came way down in here. If you're using it on the daily, because you're not in it for that long. Let's see, by the time 11/9. So at this point, you're only 41 days in, up 25%. So let's say we're still using the daily. It hasn't triggered any of those rules, but you're just down to your core position, your 15% position. You would have sold things because of the general market and because what this was doing. Let's go one day at a time. Okay, so now at this point, that's your quick because your RS line is through your short-term one. Go out another day. And it's back above it, so you don't have to do any selling. Okay, quicksand because your RS line is back below where it first went through. So now you're just down to your 5%. And look, we know it's going to get triggered. That's, wow. I guess we see, I don't remember what happened. Shocking. Let's see. You still have that 5%. Market is terrible. Let's go over to the market. QC. Market's really choppy. Oh, no, it's a little cup with handle. Wow, I don't even remember that, frankly. Even though we know that the market falls apart, that doesn't look that bad, just being intellectually honest. I mean, 18% deep, 10% handle, shakeout in the handle, RS line is above its moving averages. That looks fine to me. But the problem is it couldn't break out. So you get, here was your alternative pivot, buying it here, adding to it here, adding to it here. Now your expectation is for it to go through the standard. And by this time, when it can't even hold the 21 day, you would be backing away from any of those shares because that's not how an alternative pivot works. When it starts fading that quickly after an alternative buy point, you have to expect that it's going to want to shake out one more time. Now, we're looking at patterns and understanding how they work. Where that becomes helpful is at this point, if you were to, this still looks normal here, relatively normal, like not, doesn't mean that we haven't sold our shares that we've bought here and here. But you're back down to your 50-day. And lots of times when it doesn't work with an alternative pivot with a handle, it then wants to naturally shake out below your earlier low in your handle. But if you did that just in time, you look at that and just go, well, your handle is this long, would be this long, and your cup itself is only this long, basically about the same, give or take. That's not normal. Normally your handle is very proportionate to your cup. So anyways, we're going to go forward. So at this point, well, we have already sold it, but you still have your 5%, right? Oh, yeah, you still have your 5% because it hasn't gone through that. We're using our daily, hasn't gone through. Okay, finally on this day, on the 8th. And so this is the drawback to it. So on the 8th, you get your Grateful Dead signal, but you knew that the chart was broken before that. And you know that the market is rolling over. Oops, 0 undo QC. Wow, the market is totally falling apart. Wow, that's a three-dimensional chess from hell, man. That is tricky. So how do we do this? Well, we have our rules. As Bill told us, we're going to just follow these and wait and sell that 5% here, because if you start making too many exceptions on rules, while they would help in this case, they're going to end up throwing you out of some other ones. So you have to wait until this point. You get your Grateful Dead signal and you sell those shares. And again, those are the shares that you had bought over here, right? Because we were already out. So you're still way up on those shares, but you're overstaying your welcome. Let's see how this ends up playing out. Let's just go out at the end of next month. Falls apart. Let's see it on a daily. So now that sell up here that felt so late, right? Felt so late right there, doesn't feel so late anymore. Now let's go out another month. Ugly. Let's go out another month. Ugly. Yeah, I know it's bouncing, but that's still ugly. Go out another month. It's ugly. Let's just go out to the weekly. Let's go out to the bottom of the market. It was in March of 09. So look, I mean, yeah, we sold it over there, but we were able to get out of all of that mess. Now let's look at it on a monthly. Again, our monthly, if we had used that last 5% on the monthly, we would have waited until February of 08 to trigger that one. So let's go back to there for the people who don't like all the added selling, and I totally get that. Actually, optical illusion, I guess it goes through it on the end of March. So here is where you would have sold it with the Grateful Dead rules, your last 5%, that you would have bought way back over here. So you can see, I'm going to stop sharing for a second. You can see how tricky it is. Like, you always, see these charts that we put out of, Google from here to here and is up X% in X number of weeks. But unless you really go through it, you don't realize how hard this is and why if you're going to get good at this, you're going to have to put a lot of time and effort into it. And the more of these you do, the better. And I'm just walking you through, like, this is my procedure. And this procedure, if I did this a year from now, is going to be different. And 3 years from now, if I'm blessed to still be around, it'll be different again. And because you're always doing this and picking up on things and using new rules. So that's what you want to end up doing, is developing your own rules. Now, I know that I went long, and my better half wants to go to dinner, so I'm going to finish up the IPO base kind of story quickly. So let's go back to, I'm going to share. Should just start these earlier in the morning. Starting the IPO base. Let's see, it was an 04, right? So let's go to 05. That was down here. And remember, I said that Bill was told by some of the other PMs it's a high type flag, and he wanted to believe it, so he believed it. He knew better. I mean, it priced out at 85, goes up to here. That is not 100%. 85 to 113. I didn't always do well in math, but that wasn't, that's not 100%. So that was a problem. And I'm a bit, I'm going to stop sharing. I'm a bit of an OCD type of dude, if you haven't figured it out, and I'm kind of an overkill kind of guy. So what I was, thinking at the time was, wow, how blessed we are that these two guys told Bill, um, the story. There was a high tide flag, and to this day, like even when Bill retired, he still referred to it as a high tide flag. It just is what it is, man. But that didn't sit well with me, and I can be very black and white about things. So what did I do? I went on a journey of studying IPOs. I said, there's something here, because we all instinctually knew that that was going to go higher. And there was something, I think it was Google. Let me, not Google, eBay. Let me, I'm going to share this. I think I haven't looked at this in well over a decade. We're going to look at eBay at its IPO. So we're going to go to 1999. Go to the daily. Okay. So 98. Just randomly pick one. Okay. So we're going to go. Okay. So it was this one that I had in the back of my head when I was trading, when I saw Google 1026, that I was thinking that it was like this. Now the percents are completely different, because you calculate your base from here to here. But this is what I had in mind. And this ended up actually being, I brought this up um, in one of the last episodes, November 18th of 98. So this is when I had the guts to go ask one of the PMs, because I wasn't a PM at the time. I was in the research department. Hey, can I borrow your, I knocked on his door. I was scared to death. I was completely scared to death. Didn't knock on his door, excuse me, I won't mention his name, could I please borrow the model book that has syntax in it? I'd like to photocopy it. Doesn't say a word to me. Doesn't say a word, because you got to remember there was competition on the team, so no one wanted anyone, well, except for me, but no one wanted other people like to be interested in being a PM, because it meant you would get less of the pie. Bill had a pie of money, and so the more PMs, the smaller your slice. So no one was there to help you. Story for another day. So I knock on it and ask him, hey, could I borrow it? And he doesn't say a word to me. He takes out the green model book, the Bill's first real model book, hands it to me, stands over me while I photocopy it. I hand it back to him, said, thank you so much, and doesn't say a word and just goes back in his office, closes his door. So that was welcome to the PM world. But that's it is what it is. As Gecko said on Wall Street, if you want a friend, get a dog. So, anyways, I asked them, to photocopy this, syntax, because I thought it was a high tide flag, and I thought this was a high tide flag, and it is, in my opinion, is not a textbook high tide flag. But anyway, so I had this in the back of my mind that this was an IPO, but I didn't. Stop sharing again. That so I just had a sample size of one. Well, for me, sample size of one isn't enough. So what did I do? I asked our programmers. At the time, I think this was at that time, I was our director of research and development. So I was able, I had a team of people working for me and with me, and a great group. And they, had access to programmers. So I went to one of the programmers and I said, hey, could I get a printout of every single stock, dead and alive, meaning, and I wanted them that ever went public, and what day that they went public, and by dead meaning ones that have merged or gone to zero, or whatever. They're no longer active. So that was what we called the morgue, which were all the dead stocks, and we had tens of thousands of those. And that's really what was so important about Juan's database, is you had the dead stocks, not just the active ones. And that's really, really big deal. So I said, could I have a list of it? Are you sure you want all of them? And so that's every stock ever from 1963, because at that point we just had it from 63. Later, Chuck and I did something from 1880 to 63, and that was a multi-year project. I'll do a webinar on that, or a podcast. But the point was, I got that, and so every day, what I do is I just started at the beginning of the list. It was this big monster list every day for months and months. That's all I do all day long. Is I would just pull up one IPO after another, just with an open mind. And this is where the Bill's fish story really always stuck with me. So he would tell this story of a Harvard professor. I think it was a Harvard professor who asked his students. It wasn't a Bill story. It was an old story that Bill would tell. It's in the book. That Harvard professor asks his students, "Hey, give me a report on fish." And so they all go to the library, write this report on fish from what they've read, and he tears up all of them and he says, no, if you want to learn about fish, this is so important. If you want to learn about fish, go sit in front of a fish tank and study fish. And I've taken that to heart, and that's how I do all my research. So I was like, what better fish tank than just sitting in front of every stock that ever went public? So what I would do is every day I would pull up the stock that went public in 1963 and then go out like a year and look at them. Because again, remember, I couldn't rely on, any of these books, and maybe they've talked about IPO bases or something like that, but I couldn't, because that was a no-no. So I had to, so it forced me to figure out how to do things myself. So months and months later, I came up with these rules for what an IPO base is. And that was the only base that's been added to the IBD methodology that didn't come from Bill, and it came from me. And out of that work, and I'll just share, how you can kind of do this, and how some original research, kind of do a subset of what I did. Let's just go back to the current day. And I built this very basic screen in market search IPOs. They just simply put in here the IPO date, which you can find down here in general criteria. Or let me zoom this out so you can see it. I just put from 2020 to now, 910 stocks. But really, I would have done it from 1963 to now, but include the ones that are dead. So tens of thousands of stocks. I mean, like, I was hardcore. And let's just sort this and say no closed-end funds. So we have 910 stocks that have gone public since then. And then let's just sort this by things that have fallen apart, because this is an important thing. Let's just do ones that are down from their 200-day. Let's see. Just start here randomly and go out to the weekly. And imagine just playing through. I'm going to do space bar, which we'll get to the next stock, one after another, of seeing these. Well, here, I got to change this to best fit so you can see it. One after another, I would do these, and I would change the date to a year from when it went public and study it, just with an open mind. Like, what did I see? What did I see? And what you'll get, and I just randomly picked I sorted by the furthest currently from its 20 or 200 day, but I did this for all of them, and I walked away with, wow, most IPOs fail. This is important. Most IPOs fail, but every once in a while when they work, and I was doing this earlier to see some examples of what worked, and I flagged some. Let's go into favorites and go to my flagged list. So like Palantir. So here was an IPO base over here, and I remember trading that. That was 2020. So let's go over there. Let's go to 21. So you can see little IPO base here, a little bit longer than normal. Let's go November 5th. Classic IPO base. Now, the only thing that's wrong with it, what's wrong with it? Yes. What else? Yes. What else? Right. Okay. Well, the first thing you probably picked up was there wasn't a prior uptrend. It was just the first day. So that was a little knock against it. Normally you have 2-3 days up to 25 days. Where it priced out which was cheap. You really want it higher the better. And let's see, how deep is this base? Oh, shoot, I need to go out a little further. 22%, so not too bad. But at least it was 25 days long, so a little bit longer than normal, which is helpful. Let's go back to 11.5. So on this one, you could have bought it some here. Probably wouldn't because it was under $10. Bought some here because it was going over this prior resistance, formed a little like handle-ish type of thing, added to it here and added to it there. And let's just go out to the end of the month. And as this monster move up 161% in a really short period of time. Now let's reset to today. And you can see that, you know, it ran up there and then had this base breakout failure in 21. So they don't always last forever. But what are some of the other ones that I did so for you guys to study? I typically don't look at bios because they can have really big moves, but lots of times it's unrealistic to trade them in any big way because they don't, you know, they're story stocks. Let's see, DOCS. That's one that. Oh, let me take this off. Stupid stuff. Okay, you know, sometimes you'll get the shakeout before it goes. GEV. This was, you know, the spinoff. We're studying, so you know from there. Certainly way, again, lots of times they'll have the breakout, a shakeout, and then recover, and so you want to study those. Zim, IPO base here, monster move there. I remember I think our good friend Marty, Mr. Crux, was in this one during that time frame, if not mistaken. Oh, Viking. This is one really interesting one. Not a huge move. Upstart. You know, worth studying and studying how you would have handled this. That's a tricky one. I'll put this on so you can see the whole thing. Best fit. Why didn't that? I should have fixed that. Huh. That's problematic. Well, no, I wouldn't have flagged in video for the IPO. So anyways, probably the first one I would study would be that Palantir. Certainly worth studying that one. But anyways, I'll stop share so I can finish this story. So I went through all of them and then developed the rules. And again, to summarize the rules, a flat base, or it's kind of like a flat base that happens after it goes public, but it can be shorter. So it can be as shallow as 5% deep. Some of the best ones will really be, you know, let's call it 10 to 20%, but really in the 12 to 15% deep. Can be as short as 10 days, occasionally an 8-day one in there. You know, you can have some long ones too. They can be, you know, a few months long. Your left side high will start typically within the first 25 days of trading. And that's it in a nutshell. And then your standard buy is as it goes through your highest point that it's had so far. But again, use those alternative pivots. So anyways, fast forward that, you know, it was going through, created this, looked at all of them. But I was always telling people that, oh, these IPOs have a high failure rate because I looked at all of them. Now, we've never looked at every single cup with handle or every single flat base or every single anything else. And if you looked at every single one, you'd walk away with the same idea that I had from the IPOs, that the ones that worked really worked, but most of them failed. So I just always took it like that. Now, we've kind of reverted to a time where IPOs are a little bit different now because the whole private equity and everything, that's a topic for, you know, another time. But there have been things that have materially changed how IPOs are. They just come public much later in their life cycle now because private equity takes them for a lot longer than they did historically because there's just so much private equity money. When that starts drying up, which it will, everything goes in cycles and dries up a bit, we'll revert back to a more normal IPO market. I don't know when that's going to happen, but you'll start noticing it because you'll start seeing a bunch of these working. But we'll go back in time, go back to the future. And in 2013, I did a big base study on every base from 1963 to 2013 in our database that broke out with a pivot above $10, split adjusted, so whatever it was trading at that time, $10 in each year. So in 1963, I removed the bottom either 10 or 20. I think I sliced it a couple of ways, 10 or 20% of from dollar volume. So the really thin stocks I removed because we wouldn't trade them, and studied all the bases because I wanted. That was a large part of why I built the pattern rec, is because I wanted to see what made a base work. Like, which base was better, what length was better, what stage was better, what characteristics of a base, all these things I wanted to slice. And that's what I did, that big 2013 study that I learned so much from. And I was scared to death about doing the IPO one because, one, it was the only one that I came up with. And I looked at all of them and I'm like, they don't work, like a lot, and so the numbers are going to be terrible, but I'm like, I've got to study it, I've got to study it to see what those numbers are. So I'm going to share, this is from a home study, and I'm not trying to sell the home study. This is my home study that I built from scratch, that I did, and shared, and IPD sells it and they make the money. I don't make a cent from it, which is funny as can be, but I don't make a cent from any of the things that I create. I guess I should have had an agent back in the day, but I still think people should get it. And they have some crazy low prices on them now. I think it's because they don't do the print books with them, but it's like only a few $100 or something. It should be so much more, but it is what it is. If you can afford it, I would suggest doing the home studies. I would really start with the one that Charles and I did last year. That was live chart school. That would be your first one. And if you like that one, reach out to me and I would tell you which one you should do next. Maybe the original chart school, and then probably the market school. I'll just tell you now, the market school. IPO would be kind of low on the list just until we get into a good IPO market again. But if we get there, you want to know how to do it. And so I'm going to share this with you. Share the results. So this is from the IPO study, and I was shocked. And I triple, quadruple checked this. Let me blow this up a little bit. So this is from that home study, and it's pretty much all I can really share with it. These are the model book move, and I won't get into all the details of what a model book move was. It's totally automated from that sample size, 1963, 2013, and this was the IPO base over on your far right. So you can see the cups with handles, cups without handles had about the same success rate. The saucers with handles were the lowest. Your ascending base was pretty high, but that has a very small sample set. So it can be a little bit, skewed when you have a smaller sample set. When obviously IPOs have a smaller sample set because you can only have one IPO base. A stock can have unlimited number of any of the other bases, but you can only have one IPO base. But still, with that, no matter how I sliced it, the IPOs had the best performance. I was shocked. I never went and told Bill that because that would be like, wouldn't be cool, to say, hey, my base was better than any other base, but it was. And so that's the truth, man. I've never said it that way, but it is what it is. But I will say, if I were to do this again during this time frame, like the last 10 years, I think it would be flipped because with the private equity, lots of these things, they break out and fail, break out and fail. But every once in a while, you'll come across a Palantir in there. So you do have to be careful. I think everything will come back around. Let me share one other thing on here. Let's see. In this IPO home study, I just want to show what when I went in here, what did I used to look like? Let's see. I'm going to go in here and I'm going to just fast forward so you guys can see a young Webby. Look at that. Look at that kid. What happened to that kid? I was so young. And clean cut. I don't wear suits anymore, but anyways, that was that. But really what let me see. Stop talking, Mike. But that was that. The other thing I wanted to share with you, and we'll kind of wrap things up. I'm wearing my Buddy Guy shirt. What Buddy Guy is one of my favorite um, guys out there. He's a true legend. He's referred to as a legend, but he is a legend. And here is are his. We're blessed that he's still with us. I can't make it to these Austin shows, and it's killing me. I'm going to be um, away most likely, but I've got to go to another one of these. So try to go see him if you can while he's still here. The Beacon Theater. I've always wanted to go there. Those would be great shows in New York. And he's playing with Tedeschi Trucks, who Tedeschi Trucks is just an amazing band, just absolutely amazing. And the last time I saw them was, so here are all the different dates. So definitely go check him out. And here's Buddy Guy, little polka dot dude. Last time I saw Tedeschi Trucks was actually with BB King, who I'm a huge fan of, and I took my son to go see him at the Hollywood Bowl, and that was the day that John Mayer came out and played at the end with them, and it was so sad because I'd seen BB King so many times. One time, front row center at a little place called the Coach House in San Juan Capistrano. I think it was San Juan Capistrano. It was literally could have touched his foot the whole time. It was just a huge fan of his. And that album up there, my son bought me for Christmas this year. Very nice of him. But anyways, the point is about Buddy Guy. He's still with us, but that was the last time I saw BB, and I knew I'd seen him many times and brought the kids and everything to him. And so Eric and I were there, and I'm just like, Tedeschi Trucks opened up for him, and then BB King played, and it was just sad. I just knew it was going to be the last time I was going to see him, and I kind of feel that way about Buddy. And I can tell a story about that in maybe in a couple weeks about how special that going to see Buddy was in March of 2023 with my son. I've seen him since. Um, and very special guy. What's really cool about him, and I know this is non-stock stuff, but it is what it is, that one of the other times I saw him was with my son, and we were at this small place in Orange County. I forget the name of it, but it was kind of over by Angel Stadium, and we were in the second row, but on the far, far right, like the furthest. They really even shouldn't have put seats over there, but we were sitting over on the right, and so I was on the edge, and Buddy was sick, kind of like I'm sick, but he was really sick, and he's up there in age, and he kept on having to leave the stage, and no one could see him, but like I could see him because I was on the far right, and my son could see him a little bit, and he was not doing well. I mean, he was so sick, sick as a dog, but he would, we'd have a towel and they'd give him drinks and stuff, and then he'd come back out on stage and smile and act like there was nothing wrong, and then he'd go over to the side because he knew that people were there and counting on him, and the staff was there, and the rest of the band was there, and people had traveled and made plans to go to the show, and the show must go on. And I got to say, last year when I did that chart school with Charles, that live chart school, I was sick as can be. I had COVID really bad, like really bad. But I thought of it that day, like I couldn't, I didn't want to cancel it because I knew how many people it would impact. And I was like, well, what would Buddy Guy do? The show would go on. So if you watch that, you probably won't pick up on how sick I was. But man, as soon as that was over, I think it was like 6-7 hours or something like, I don't know, maybe it's 5 hours. I went straight to bed for a couple of days, man. That was bad. But the moral of that story is, man, be a man up, or woman up, whatever you want to call it. If you got to do something, people are counting on you, you've got to do it. And when it comes to and again, I tell these stories because I really wanted a place where my kids, or if I, am not fortunate enough to be around to see my grandkids, that when I have them someday, that, or when my kids have the kids, that, there's a way to see grandpa, and what did grandpa do? What did I heard about that Webby guy. What did he do? And so I just wanted a place that I could just have recorded these and put them on my computer. But I thought, computers come and go and you lose them. So if it's on, YouTube, it would probably be around. So kind of, I was explaining it to someone the other day. If you've watched the series How I Met Your Mother, kind of like that, like telling the kids, if someone's not around. So that's what these are for. So if I go off on tangents, please put up with it. I'm giving out a lot of stuff that I could charge a ton for. But to put up with it, you have to put up with my stories. So that's that. So that was the IPO story. That was the Google. I hope you got something out of that. And really, the moral of the story with the IPO base is if you can't figure out something, do the fish tank thing, and just look at it, look at it, look at it. And eventually it'll just jump out at you. Now I see IPO bases like they were always there, and you never know what you can come up with and how special it is. And that's about it. Now, remember, your tuition for this is to go out and do something nice for a stranger or a family member or someone who's not expecting it, and just pay it forward. And I do have a special one that I'm thinking about doing that has nothing to do with stock. So if I put something out there, I'll put something on there to let you guys know that, hey, if you don't want to hear my stories, you don't have to. It's just going to be a motivational one. Um, and I might do a series of those. So if you're not into those, hey, that's no problem. Just don't send any hate. Like I read all the feedback. If you send any negative feedback, man, you got some serious negative karma coming your way, because I don't have to do this, and trying to help out folks. But I read all the comments, so keep them up, and I appreciate all of them. And that's it. Peace out, guys. Take care.